Welcome back to the LPR Trading Group YouTube channel. It's Dave again. I've got another video for you guys today, and this one's going to be putting a regular bar chart or a candlestick chart side by side with a TPO chart. And what I'm going to be talking about is draws on liquidity, and we'll be talking about how we can see those on the TPO charts as well. Now, this channel and this playlist is all about how we can combine ICT type methodology with order flow trading. Now, on the left side of our screen here, we're going to see this is a TPO chart, okay? And then this is your normal bar chart or candlestick chart, all right? In these two examples, we'll be able to identify draws on liquidity in two different ways. In my opinion, finding the draws on liquidity are sometimes, most of the time, for me, easier to see on a TPO chart. So for example, what I see on this TPO chart here for the current price is this is a potential draw on liquidity, and so is this. Now, why? Why is this a draw on liquidity? Well, the way the market works is the market has to form trading excess in order to complete an auction. So if we look at today's high right here, you see these I periods. This is trading excess. It's single prints in a given period above a high or below a low. That will complete an auction. Now, to give you guys a breakdown of what TPOs are all about, let's zoom right in here. This is today's price action on the TPO broken down into a period by period range. To keep this very simple, each letter period represents 30 minutes of trading time. TPO is time, price, opportunity. Okay? So the first A period is a 30-minute bar. B period, 30-minute bar. C period, the next 30-minute bar. So A period would be 9:30 till 10. B period would be 10 to 10:30. C period would be 10:30 to 11, so on and so forth. Okay, so when I'm looking at the TPO charts, I want to look for highs or lows that have equal highs or less than one tick removal from the high, one tick of excess above the high. So in this case, we can see we have an H and an I period. That means at some point, these two 30-minute prints were pretty much side by side, and we have one tick of excess in the H period. This is not enough to complete the high or leave excess on the high. We need two of these periods to leave excess on the high. Because we didn't have two or more of these periods, this equals a draw on liquidity. Okay, this is a poor high. Same thing for the low back here. If we go down to this low on the TPO chart, we can see this L and this M period. We only have one L print, one single L print. It does not leave enough excess. This is a poor low. What do we do with these poor highs and poor lows? We expect price at some point to return to these areas to complete the auction and to leave excess in the auction. Now, what is excess and why is it important? Excess makes a completed auction. So let's say, for example, you start an auction and the auction starts at $50. Whatever the item is, $50, we get an offer, okay? The price goes up to $55, 55 going once, okay, we get an offer. 60, anyone at 60? No, once, twice, three times, no one at 60. What do we have to do? We have to step the offer down to 58, 56, no offers, offers, back into 55, maybe a few, back down to 50. Okay, this left excess on the auction. We completed the auction. There was no more buyers as price went to the upside. So think of these tails at the tops and bottoms of these ranges. This is excess on the sell side. This is excess on the buy side. And excess is two ticks or more above a range high or a range low. If we have anything less than that, it is a poor high. Now I want to give you an intraday example today. So to keep this simple, this right here is a TPO chart or a profile of today's action. It's just all squished together into one profile. Beside it, we have a TPO profile that's broken down into each individual letter period, A, B, C, so on and so forth. So if we follow these letter periods, we can see once we get up to D, what do we have? We have an E period that's only showing one tick of excess, okay? we pull back an F period. We move over, we have a G period that is only one tick of excess or one tick below the E period. We have an H period that's one tick above the G period. This whole area intraday equals a poor high. Of course, not enough time has passed for us to see I period reach above these highs, but we know because we have a poor high here intraday, the likelihood of the market going up through these highs to complete the auction and leave excess is very, very high. What does the market do here? The market moves up an I period through these highs, and if I draw a line across here, it leaves approximately 4 ticks of excess above the high, then turns around and returns price down. This whole consolidation period, price could not move down. It had to wait for the auction to complete, make excess, and then we could turn around and roll over. All right? This is the same thing that we're looking at when we're looking at the ICT methods and models. If we go down to a 5-minute chart here, okay, and we look at this, these are roughly those period highs, okay? We've got a high, we've got a slightly lower high, slightly lower high. We've got a higher high from here. We've got an equal high. This is where we want to take the draw intraday. Okay, this is the intraday draw. What does the market do? It drives up, it leaves excess, completes the auction, and then we turn around and reverse. So for me personally, it's easier to see these things on a TPO chart because I could just simply go through the TPO and see if we have less than one tick at a high or low. That equals a poor high or a poor low. On top of all that, we can also build in to this TPO chart a line just like this that gets auto plotted if we have a poor high or a poor low. And that line won't go away until we intersect with it. And that's the whole idea, is these drawn liquidity areas, poor high, poor lows, they will stay there until the market finishes business and liquidates those highs. Now, it doesn't mean the same as the ICT model. It does not mean that because there's a poor low, we're going to go down here and reverse off of it. It just means the market has to fill up that space. All right, there's a draw on that space. Now, one more bonus for today's video. Another very important thing about the market is balanced areas. And I won't get into the whole balanced area thing right now, but I will talk about one aspect of the balanced area, which is going to be point of controls. We've got a TPO, a time point of control here. This is time based. This is the most time was spent at this tick value. And we've also got a volume point of control. This is where the most volume was done, was at this tick value. Okay. Now, if we ignore this profile in the middle here for a second and we look at this profile, what happens in A period? A period opens up, we drive to the upside, and where do we stall and reverse in B period? Yesterday's time point of control, right? So if we go like this, and to make it easier for some of you, this time point of control is 45.25. We go into a 1-minute chart on today's action, and we'll go like this, and the open was here. We got up to 45.25.75 was the high. What was yesterday's time point of control? Let's just put a line here to make a reference. 45.25. This was yesterday's time point of control. What did the market do? It drove up. It came back into balance. It retested that naked time point of control. And then we got rejected. Okay? So these are some areas or some other ways we use these TPO charts in order to identify very critical areas. Another very nice play from today was when we started trading in this range. We opened A period, we pushed up to yesterday's time point of control, and we completely tanked, right? Two things could have happened here. We could have gone for this poor low right here at 4,500.75. As soon as we started reversing, if we look above price, what can we see above price? We can see the weekly volume point of control above price. This is a very, very important level. We can see yesterday's value area high right here. We can see the weekly value area high represented by this dashed line. Now, do you see the targets that came into play here? We hit yesterday's time point of control, we reversed. We hit yesterday's value area and weekly volume point of control, and we started chopping, okay? And where did we chop to and from? All of these pullbacks, where did we like to hold? Our time point of control on the day. We were also holding our volume point of control on the day. Now, when we broke through this high, which was a poor high and we had to make X's, where did we go to? One tick from the weekly volume point of controls, or the weekly value areas high. These are very, very critical areas in your trading. And what TPO charts helped me do was look at the bigger picture. And this is what the ICT model is telling you to do as well. Look at your bigger picture, form your higher time frame bias, and trade off this. Okay? If there's no trades based on your higher time frame bias, and there's no trades based on any intermediate term bias, I would not go gripping and ripping 1 minute candles. You're probably going to get yourself into trouble. Okay, this was a video more tailored to the order flow side of things, the TPO charts, because in sending out pictures, I've been getting a lot of questions about what these charts are and how they work. So this is a briefing of something that I look for in the TPO chart. I hope it helps you guys. In the next videos, I will cover some more order flow ICT concepts, and I hope that some of you guys can see the validity in marrying these two concepts together, because they do work very cohesively. As always, like, comment, subscribe, leave your comments down below. I will get back to every single one of your comments. Have a great day. Trade safe on the charts, and we'll see you on the next one. Cheers.